Okay, Charlie, I'm going to give you hopefully a quick lesson here on just what these S&P contracts are. Um, I think the simplest way is treat it just like a stock in terms of the price. The price here back I've got this date. I think I picked the price right there, April 5th. I think that was it. This past April 5th, and it was $4,525.12. Okay, now treat that just as a share price. When it first came into existence in 1957, I believe it was all 500 companies, and it was priced at 100. And the what's happened over the years, just like the Dow Jones, is that companies within the mix of the Dow change, and then there are stock splits on top of that. So there are adjustments just for the exact same reasons for the S&P 500. The construct of the S&P 500 companies has changed over time. Some drop off, some join, and then there are stock splits. So there's always an adjustment to the index number. And so that 100 is now $4,525, spot 1-2. Now, let's just treat that as the share price. Its multiplier used to be the price times 100, and because the number got so big, they split it in half, or they did it basically just like a stock split, 2 for 1, and the multiplier went from 100 to 50. So that's the history of it. You don't have to understand any more than that. So whatever the price is, just multiply it by 50, and that's its actual value for one contract. So on this particular date, here back in beginning of April, it was 226,256. Now this symbol up here is $SPX.X. That's the symbol for the actual cash S&P 500. Down here we have this one that's labeled ESM22. ES is the symbol for the S&P 500 futures contract. M is for the month of June of 2022. Now, there are 4 contracts per year in the S&P 500. There are March, June, September, December. Symbols H, M, U, Z. What does that mean? I'm going to give you a practical application for why people use, and it all started with, corn and wheat and soybeans, the agricultural market. The financial markets began using futures contracts along the way. So, for the same reasons. The real principal underlying reason for futures contracts are for the purpose of protection. So, for example, you've got a portfolio of stocks, in which you do, and those stocks can go down, and if you have yours, for example, right now locked up in an IRAs that have been rolled over from your 401k, it's very hard, it's clumsy and cumbersome to try to time the market and sell off your shares, and then all the trouble of buying back in. It's just an enormous task. A simple way of protecting yourself, again, is to put against the dropping value one of these contracts. They will basically, in this case, if for one contract, for that value right there, if you had stocks valuing approximately that $250,000, you could short one contract. And as it drops in value, as you can see it did here all the way through, now what's this date I pegged here, June 16th, it dropped from 226,256 down to 183,338. And I don't know my quick math right here. What is that right there? Quick math, that's $43,000 that it dropped. Now, how do you sell something that you don't own? Let's go to that extreme. I always say, you want an example, always go to the extreme. Let's say you don't even own any S&P 500 at all. How do you sell something you do not own? Let's use IBM again as the example. If you can open up a brokerage account today, and let's just say IBM's worth $100 a share, and you're gonna short 100 shares. How do you sell something you don't own? Well, you borrow it. And where do you borrow it from? Well, inventory. Well, who's got the inventory? Well, the brokerage firm does. And there are other people who actually allow their shares to be used for shorting. They get to collect interest on that. But we won't even go into it. Just treat it like the house, the brokerage firm. It's got shares. You get to, what happens when you short something you don't own? You're going to borrow it and instantly sell it. So you sell 100 shares for $100. You got $10,000 instantly credited to your account. I don't care if you only had $5 in your account. Boom, you got $10,005 in your account. And what happens? Sure enough, your analysis was correct. IBM drops to $90, and you say, it's what's called cover my short. So you cover the short by buying the shares back, and instantaneously, as soon as you buy them, they are instantly delivered back to the brokerage firm. And what happens? $9,000 goes out of your account. What are you left with? $1,000. The name of the game is always buy low, sell high. You're just reversing the timing of the transaction. You're selling it first and buying it back later. How do you do that? Borrow and then redeliver. That's the same thing with a futures contract. A futures contract is a commitment. Here's where I want you to understand what a futures contract is, and this is not complicated. A futures contract is a commitment for someone to either deliver the portfolio or to take the portfolio away from you. And in this case, what you're doing is you have an IRA. It's got, let's say, this $250,000 of value in it. And what you are doing essentially then, by shorting a futures contract against that portfolio, when you make that transaction, you've done that with somebody out there in the world. You don't know who, but there is a commitment by someone on the other end of the transaction to pay you $226,256 for your portfolio, even though it drops down to a value of $183,338.50. And just for the sake of the example, it's going to, let's say that happens. When's that transaction going to be completed? When are you going to actually exercise it? Let's say at the last day, the expiration of the June contract. On this case, June 16th, there's a certain Friday every month, every maturity month, March. I think it's the third Friday of March, June, Sep, and Dece. There's the expiration day. And let's say, for the sake of conversation, that's the day the transaction will change hands. You will deliver all of your shares of your S&P 500 to some entity out there in the world on expiration day, and they're going to hand you a check not for $183,412. They're going to hand you a check for $226,012.50. Now, they're not handing it to you for this, they're handing it to you for that, because this is the contract. Here's the cash. Now, I put these two against each other, the actual cash price and then the futures contract price, because you'll notice this little number down here. There's a difference between the price of at any point in time all along the way, there's a difference between the price of the cash, S&P itself, and the futures contract, in this case, the June contract. And what is that difference? It's a built-in interest rate. Why? Because you're essentially borrowing the majority, in fact, approximately 95% of that $226,012.50, the futures contract. I'm going to take you to an actual transaction right now so you can see what that's called. It's illegally, and if you take your exam to have a license in this industry, if you answer that it's margin, you will be marked incorrect. That's the common vernacular for it. But it is legally, it is escrow, just like buying a house. You are obliged, if you enter into a contract, whether you're on the shorting it or buying it long, you are obliged to put down approximately 5 or 6% of the value of the portfolio in escrow. And it's called margin. And I'm going to actually go to a live screen. I'm going to execute a trade. It's live, but it's a simulated account just so that you can actually see what really happens. So at the point of this transaction occurring back here, in April, the difference in the price was $243.50. And you can see if you follow the line here, as you get closer and closer to expiration, you get down to expiration, and you're talking about, it's actually a minus here, $1.48. But the spread narrows down to, 243 down to 148. And so what you're really looking at is the built-in interest. You are not going to get, you're going to retrieve when you get your cash out of the deal and you delivered your stock, you're going to get $74 is going to be returned to you, not 243. What's that difference? It's the interest rate. So now let's actually go and execute a trade using this is live right now in the marketplace. So I'm going to switch over to a live screen and actually show you a real trade. You are now looking at the S&P 500. It is the ESU. It is the September contract. That'll expire the third Friday, I think it's the third Friday of 2022. And even though it expires then, that's just the life of these contracts. They make it, 3 months, 4 times a year. But you just will continually roll it. And you'll notice that when you roll from the September, that margin difference of dwindled down to $74. Once you go to the new contract and the new for the next 3 months, they'll bump the spread back up again and start recharging you interest again. I'm not going to go and show you that particular contract that we're in right now, but same dynamic. They just start the interest rate over again. So now you're looking at this thing, and it's moving very slowly. In fact, I'll show you the volume right now. Here is the, there we go. I'm going to enlarge this. Here is the September contract, and you notice these are all you see how big it is during the day. Once 8:30 opens up, very, very, very big, and then it dwindles down at 3 o'clock. It closes at 4 Central. Yeah, but it trades all night long. And you're actually seeing that right now, you can hardly see it. 53 contracts, 63, 64 versus like at the peak of the day, you're looking at, 51,000 contracts right about to that particular time. That was somewhere, in the morning, 8:40 in the morning. So now, let's go to, this is a 50 tick bar, well, not a 65,000 tick bar, but a 50 tick bar. Every one of these is 50 trades. And it's moving very slowly, but you can see, just watch right there, and you can actually watch this green number change. And so it's actually going right now. Now, see that green bar? That's my forecast price. You can see how it was calculated right when this changed, about an hour or so before the close of the market. Not 2 hours before the close of the market, I recalculate, and this is the most probable value on the downside. And you can see how it kind of aggregates around it. Now, I'm going to go ahead and I want to take a look at my 500s. Sold off this is the close of the afternoon session, beginning of the evening session, drops down, goes up, comes down. I'm going to risk that it's going to be going up. So I'm going to go back. This is 500 trades, a 500 tick bar. I'm going to go back to the 50 tick bar. And even though it's kind of high here, I'm going to go ahead and I'm going to buy one. Here's one contract, buy it. There's the ticket. I'm going to buy one S&P, that's the ESU September 22 at market, and that's duration's good till cancel. I'm just going to mark it, buy it.
Order filled.
It tells me that I'm order filled. Now what I'm going to do is I'm going to go up and I'm going to go and look at the trade manager. I'm going to open up the accounting system for all of this and go over to balances for futures. I'm going to take this and I'm going to move this up. And what we're going to do is we're going to go down and we're going to look at this particular line right now, real-time initial margin. That's what you have to have, $11,550 in order to secure that contract. Notice it's $11,550. Now, once it's on, then they call it maintenance margin. It drops $1,000 where you have to have that much in the account. Why they do that? Why don't they just keep the $11,550? I don't know. But that's what's required. But what's it really worth? What's it really worth? I'll close this out. Close that, and you're looking at, oh, look at that, we're up $112. It's worth right now $37.55.56. So you take that and you simply multiply it times 50, and you know we're talking about that, you know, that 180 some odd thousand, whatever it is. But that 11,000 represents is a fraction of the real total value. So you are buying leveraged to that degree. Do you care? No, because you really are trying to protect the full value. The fact that you don't have to come up with but a small fraction of that amount in order to secure that kind of protection is great. Now, obviously, right now, if you went ahead and shorted a contract, your real value, your portfolio in your 401k or IRA is actually going up by this amount, by right now $112.50. But in this futures contract, you're actually losing that much money. Why? Well, no, wait a minute. I went long. I did. I'm really goofing you up here. If I went short, this would not be green in color. That would be red in color, and it would be you'd be losing money going up, because now, you know, you've agreed with somebody out there that at this point they are going to, let's say at expiration in September, let's say carry it all the way out to September, regardless of where this portfolio is valued, you've agreed to this particular price right here. Whatever that number was multiplied by 50, you're going to deliver your portfolio and they're going to pay you that amount of money. And in this case, you know, if it keeps going up, they are going to be the winners on it, because you're only going to get that amount. That's it, because that's what you're committed to. And so what are they going to do? Well, they're going to be very happily, they're going to go ahead and take your portfolio, pay you that amount, and they're going to instantly, they're either going to be happy because they bought it at a great price and now they're happy as all get out, or they're going to sell some of it or all of it and just make the profit on it. But you are willing to go ahead and sell off your portfolio at that particular price right now by going long. Conversely, you know, what we're looking at is shorting. Why? Because we want to protect, we think it's going down. So we're looking for good spots on rallies in order to reset the trade. Okay? So right now, if you take a look, no, you can't see it because I can see the actual value beneath this screen right here. But you can see it right there. You can see that it's going up in value. And so if I sell it off, I'm going to go ahead and sell it.
Order filled.
It tells me my order is filled. And if I pull this over and I go ahead and enlarge this, you can see that it plotted. I bought it, it goes up, you sold it. Okay? That's the mechanics. That's what it's worth. That's the way the built-in interest rate works in a futures contract. And you know how you buy it, how you sell it, and if I can make that, there we go. How you buy it, how you sell it, and the money it takes. So that being said, with all this gobbledygook, and hopefully you've been able to follow it, I'm looking for you to take $100,000 and use that in order to build a cash account. With that amount of money, you should be able to manage safely, fairly securely, and I'll define what safety is here and how you protect yourself in another video, by putting on stops, so if it gets out of range, you will get yourself out of the market if it goes against you. You should be able to do approximately, with $100,000, approximately 4 contracts at any given point in time. And in fact, what I'm going to do right now is I'm going to show you this. So right now we're going on 20 minutes. I'm going to give you 5 more minutes, total time about 25 minutes for this video. What I'm going to do right now is I'm going to show you an algorithm that I wrote just as a way of testing decision making, and this can be actually automated and run on an automated basis, but I really use it in order to see, is my thinking right? what kind of profitability can I have, and I want to spend as little time in the market as possible. So really, you'll have two accounts. 50,000 will go into an account simply for hedging, the very reason we're doing this, and the other one for simply trading, getting in, getting out, and spending as little time as possible in the market. I'm only going short, so we won't get caught with the market crashing on us. Only go short. Sell on those rallies up. I'm going to show you what that can look like in a trading account. Okay, so I'm going to pause this and bring it up, and I'll show you how it works. This is a page of actual coding. I wrote all of this code. And what does all this code go? What does it all do? We're now back and we're looking at a 500 tick bar. I like this particular tick bar. Number of every 500 trades. And this is that Keltner channel that they call it, that measures the volatility range. And the actual channel itself, the actual calculation is this green line. Here's the upper green, here's the lower green. This white, I simply wrote into the code, I want to know, and here's the mean. Okay, I want to know anytime it gets within 20% of that value right there on the upside, or conversely on the downside, if it gets to that white, it's within 20% of getting to that value. The red is as far as I really want it to go. I don't really want it to getting higher than that. I will tend to really want to get out of the trade within certain margins of price. I'll let it meander a bit, but for the most part, I don't like it when it gets above this red line. But the name of the game is this. I simply wrote this code just as a general way of saying, is my thinking relatively right? How successful can I be with it? And so what I've said is anytime the price just punctures, the price bar punctures that green line, wait for it to do this action here. I'm going to blow this up. It just punctured it right there. What I then need is, once it punctures it, what I'm saying is I need what's called a downrange bar. I have to have a succeeding bar have a lower high and a lower low than this bar right here. And then but it didn't. This is what's called an inside bar. It's actually a lower high, but it's a higher low. This one right here, now you're looking at this bar. What's the relationship there? Well, it's slightly lower than this one. It's about even right here, and it could even be even itself. But this one right here is definitely what's called a downrange bar. You look back one, and sure enough, this high is lower than this high. This low is lower than this low. So if that's the case, then execute the short trade on the very next bar. When it closes, this opens at exactly that price, and it shorts right there at that particular price. Now I'm going to go ahead and contract it and go back to this right here. So it goes up and up and up, and it just barely starts to get above that red line. And it fails down and goes down, and I've programmed it so that if it gets to the median, cover it. I've got another one that says it's got to get all the way down to this particular level to cover, but just to make it easy, just cover it right there. And so it goes. If it goes $150 lower than the entry and comes back on it, it'll stop itself out at what's called a break even. In fact, that happens right here. I'm not going to open it up to show you, but I've got ways of saying, look, I don't want it to run away on me. If it goes in my favor by $150 and then it backs up and it gets back to the entry, just kill it. Otherwise, let it run and then cover it there. Now, what I'm going to do is I'm going to show you the report. Go down to data, go to strategy performance report. Now this one I started running this one. You can't see it because it's a little bit above the window here where I'm recording on. Started on June 13th, okay? These are all the trades from June 13th all the way through, and you can't quite see the bottom either. It's cut off by one line. How much have I made? I've made, boy, oh boy, oh boy, you cannot, I'm going to have to just simply tell you, I made $7,036. Let's see if I can show you the performance graph. Will that show up? By golly, the performance graph shows up. So from the 16th, from the 12th, the 13th of June, until today is the 22nd, we're up $7,000 on one contract. $11,500 has made $7,000 since the 13th of June. Now that's when I rolled over to the September contract. I'm going to show you the results for the June contract because I actually started this I think on May 5th. Hang on, I'm going to pull it up. Okay, here's the March contract. Started that one on March 31st, and so that got us up to 30,000. So from March 31st, take that 30, add the $37,000 on one S&P contract. It's full value, about $250,000, and so beginning with April, May, June. So for 3 months, that $250,000 is up $37,000. Now that's shorting. We're shorting all the way. These little flat spots you see are spots where it got to its $150, but then it was going against me, so I stopped it out at break even there. So that's where you're at. That is simply using one of the 50,000. We're going to open two accounts. One $50,000 account, simply using one contract for hedging per $250,000, and the other 50,000 we will use for trading. And even if we just did it with one contract, good enough. But it's okay to use a couple. So that's a detail we can always chat about later. But that's what the mechanics are. Just take some time, watch this video a couple of times if you need to, write down some questions, and we can go over it live. So just to really get your brain locked down as to what this is, how we're doing it, why we're doing it, and this is the way you can make money protecting with a hedge, one account for pure hedging, the other one for pure trading. The hedging part will protect you from wherever we start. For any time it's going to be going down, we'll have the futures contract on. I'm gonna get rid of this particular image here, and then went back to the 65,000. So that March 31st. So that literally, I was showing you that entire drop. Okay, and so in real value, we're looking at 46.19. So as of March 31st, that was worth approximately 231,000, and right now, ticking away, it's worth about 187,000. So we're looking at about a $43,000 difference, and we've captured $37,000 of that 43,000. I think my numbers are right. For virtually all of it, so it's not a perfect match, but there might have been a couple of times when I actually pulled the trade off, looking for a better rally, but I'm close. So that's essentially, that would be the hedge side of it. Actually, that was just the trading side. That's capturing so on the hedge side, we actually cover that whole thing right to current time. We never would have taken the contract off. When the March contract expired, we would roll to the June, pay the little bit of pittance of interest that goes along the way. So we're fully covered on that. The other account, we're running those types of short trades and have accumulated thus far an additional $37,000 above and beyond preserving the original value at this point right here. So you've not suffered anything. No matter where the market's going to be, we're going to wait for a rally. I'm waiting for a couple of different rallies here in order to in this case, if you actually open an account, I will wait for a good opportune entry point, secure a short contract, and then from there trade with the other balance with the second account. And so that's the goal. That's the goal. So with that, we're running on almost 30 minutes. I'm killing this and sending it off to you. So I did all this cold, unscripted. So again, watch it several times. Give me a buzz. We can chat about it. Okay? Love you.